If you have ever moved into a higher tax bracket, you know it does not work the way people fear. Only the dollars above the line get taxed at the higher rate. The rest of your income stays exactly where it was. That is how brackets work, and it is why a raise never actually costs you money. Now I need to tell you about a number in retirement that does not work like that at all. It is called IRMAA, the Income-Related Monthly Adjustment Amount, and it is the surcharge added to your Medicare premiums when your income is above certain lines. IRMAA is not a bracket, it is a step. $1 over the line and you pay the entire surcharge for that step, every month for 12 months, not on the dollar, on everything. So today we are going to do what we do on this channel. I will give you this year's lines in actual dollars. I will take one couple who goes over the first line by a single dollar and add up exactly what that dollar costs them across the year for both of them, on both Part B and Part D. I will explain why the bill that arrives this year was decided by a tax return you filed 2 years ago. And then I will give you 4 levers, including one form that exists specifically for people whose income just dropped because their life changed. I am Susan, and this is Retirement Lab, where we run the numbers instead of talking around them. Let us start with the lines, because everything else depends on knowing where they are. The standard Medicare Part B premium this year is $202.90 a month. That is what you pay if your income is below the first line. For a single filer, here are the steps. Below $109,000, you pay the standard amount. From $109,000 up to $137,000, the premium becomes $284.10. From $137,000 up to $171,000, it becomes $406.90. From $171,000 up to $214,000, $443.90. From $214,000 up to $321,000, $554.90. And above $321,000, $689.90. For a married couple filing jointly, the steps are the same, but every threshold is doubled. So the first line for a couple is $218,000. Write that number down if you are married. $218,000. Now let me show you what it costs to be $1 on the wrong side of it. Meet a couple. Both are on Medicare. In the tax year that counts, their income comes in at $218,001. $1 over. Here is what happens to their Part B. Instead of $202.90 a month each, they each pay $284.10. That is $81.20 more per person per month. Now multiply it out because this is the part that people do not picture. $81.20 times 2 people is $162.40 a month. Times 12 months, that is $1,948.80 for the year. And Part B is not the whole bill. Part D, the drug coverage, carries its own IRMAA surcharge. At the first step, it is $14.50 a month per person, added on top of whatever their plan already charges. 2 people, 12 months, that is another $348. Add them together. Roughly $2,296 for the year because of $1 of income. I want to be precise about what that number is. It is my arithmetic, done from the published premium steps I just read to you. It is not a figure somebody announced. Your own number will differ depending on whether you both have Part D, what your plan charges, and which step you land on. But the mechanism is exactly the same for everybody. And here is the sentence I want you to carry out of this video. This is not a tax. Taxes are proportional. This is a toll gate, and it does not care whether you crossed by $1 or by 20,000. Now, why does this catch careful people? Because of the 2-year lookback. Your Medicare premium for this year is not based on this year's income. It is based on the tax return from 2 years ago. This year's bill was decided by what you reported 2 years back. Think about what that does to the people most likely to trip it. Somebody sells a rental property. Somebody does a large Roth conversion. Somebody takes a lump sum or a final year of full salary before retiring, or inherits an account and takes a distribution. All of that lands on one tax return, and it produces a premium bill 2 years later, in a year when their income may be completely normal and much lower. They open the letter and cannot understand it, because they are looking at their current income while the government is looking at a version of them from 2 years ago. The uncomfortable flip side is the useful one. The income you are creating right now, this calendar year, is the income that sets your premium 2 years from now. Which means the decisions that fix this are the ones you make before December, not the ones you make when the bill arrives. Before the levers, let me name the 3 situations where I see people cross a line without ever realizing it was there. If you recognize yourself in one of these, this is your year to pay attention. The first is the final working year. Somebody retires in the middle of a year, so that return shows most of a full salary plus whatever they took out of an account to bridge the gap until benefits started. It is the highest income year of their life, arriving right as they stop earning. 2 years later, the premium bill lands in a year when they have no salary at all, and it is the biggest premium they will ever pay. The second is the house. Selling a property, especially a rental or a second home that has appreciated for decades, can produce a single year of income far above anything normal for that household. There are exclusions that help with a primary residence, and I am not going to walk through those here because they deserve their own episode. But the part people miss entirely is that the gain does not just affect their taxes. It sets a Medicare premium 2 years out. The third is the inherited account. Under the current rules, most non-spouse beneficiaries have to empty an inherited retirement account within 10 years. Somebody who waits and then takes a large distribution in 1 year, or who is forced to take one late in the window, can push themselves up 2 or 3 steps at once. Spreading those withdrawals across the full window is usually the better plan for tax reasons anyway, and IRMAA is one more reason. Now, a practical note on the number itself, because people ask me this constantly. The income figure IRMAA uses is not simply your adjusted gross income. It is your adjusted gross income plus any tax-exempt interest you received. So, municipal bond interest, which does not show up as taxable income on your return, still counts toward the line here. If a meaningful part of your portfolio sits in tax-exempt bonds and you are anywhere near a threshold, that is worth checking specifically, because it is the single most common thing people forget when they estimate where they stand. All right, 4 levers. Lever 1. Know where you are before the year closes. This sounds obvious and almost nobody does it. Sometime in the autumn, add up your expected income for the year, including everything that counts. That means taxable income and also tax-exempt interest, because the IRMAA calculation includes it. Then look at how close you are to the nearest line. If you are 20,000 under, relax and stop worrying. If you are 2,000 under, you are in the zone where one careless December decision costs $2,000. Lever 2. If you are near a line, control what is discretionary before the year ends. Some income is not optional. A pension is a pension. But some of it is timing. A Roth conversion is a choice, and both the size and the year are up to you. Realizing gains in a taxable account is a choice. Which account you take a withdrawal from is a choice. If you are close to a line, the size of a conversion is exactly the thing you have control over, and shaving it to stop just under the threshold can be worth more than the conversion's tax benefit for that year. Lever 3. Split a large move across 2 calendar years. If you need to convert or sell something large, ask whether half this year and half next year keeps you under the line in both years. Sometimes it does not, and the move is worth doing anyway. But the question deserves to be asked out loud before the paperwork gets signed, and it almost never is. Lever 4, and this is the one that helps people who are already in the trap. If your income dropped because of a specific life-changing event, you can ask for a redetermination using a form called SSA 44. The events that qualify are the ones that describe what actually happens in retirement. You stopped working. Your spouse died. There was a divorce, or a loss of a pension, or a work reduction. If one of those applies, you are not asking for a favor. You are telling the agency that the 2-year-old snapshot they are using no longer describes you, and there is a process for exactly that. I want to be honest about the limit here. That form is for life-changing events. It is not for the person who simply had a big income year because they sold something. Selling a property is not on the list. That is why the planning levers matter so much more than the appeal. 2 more things, and then I will let you go. First, if you are $1 over, you are $1 over. There is no partial credit and no proportional relief. That is what makes this different from every other number in your retirement, and it is why an ordinary size mistake in December can cost more than a thoughtful decision saves you all year. Second, do not let the fear of IRMAA make the whole decision for you. I have watched people refuse a Roth conversion that would have saved them far more over 15 years, because it would have pushed them one step up for a single year. $2,000 is real money, and so is $30,000. Run both numbers before you let the smaller one win the argument. So, to bring it together, the first line for a couple is $218,000 this year. $1 over the line, at the first step, runs about $2,300 across 12 months, once both parts are counted. The bill you get this year was set by the return you filed 2 years ago, and the return you file for this year is setting a bill you will not see until 2 years from now. Check your number this autumn, while you can still do something about it. This is general education about how the rules work, not tax advice for your situation, and the amounts and thresholds change every year. Confirm the current figures and your own calculation with the Social Security Administration, with Medicare, or with your tax preparer before you act. I am Susan. This is Retirement Lab, and I will see you in the next one.